Hello everyone, I'm Pacchia and this is Bloomberg Law on Demand. My guest today is Dan Alpert. He is the managing partner of Westwood Capital based here in New York City. Today we're going to be taking a look at the United States banking sector and its prospects for 2011. Of course, you're a frequent guest on all our Bloomberg platforms, one of them being Pim Fox. Let's channel him for a moment and put this in perspective. Are you buying figuratively or selling American banks right now?
Well, the only bank I'm technically in is Citi, and I just hold that for nostalgia purposes. But the truth is that I would be relatively short if I were playing the banks right now. I think that they are vulnerable. Now that is a very, very broad statement. They're not all equally vulnerable. And the truth is that the one bank that I would be tempted to be long is actually the one that I own, which is Citi, only because from a cleanup standpoint, their balance sheet is in my opinion a heck of a lot cleaner than the other big three banks. The reason that I'm very concerned is this. It's clear to me that, especially with regard to real estate, and now we have to remember that housing has entered another downturn, right? So this is the second dip, as it were, in housing. Our numbers show that housing should bottom out somewhere about 5 to 8% below where it hit in April of 2009, the last time it hit its low, and that's equivalent to about 11%, 10% below where it is today. So where we're coming from is that when that happens, you're going to see a lot of the whole loans that are held on banks' balance sheets today degrade. And what we would argue is that, in fact, they've degraded already. It's just that the banks, because they're not forced to mark those loans to market, have not been forced to take those losses. And just to give you some context for that, let's look back to the stress tests that were performed in the second quarter of 2009. They covered 2009 and 2010. They covered 19 institutions. Those 19 institutions were projected under economic conditions that, by the way, were better than what actually transpired. Remember, the stress test assumed unemployment would top out at about 8.5, and obviously it got a lot higher than that. But under better presumed economic conditions, those banks were assumed to experience during 09 and 10 about $600 billion worth of losses, and they were assumed to have about 360 or 80, I can't exactly remember what the number was, of pre-provision net revenue. Well, turned out they had the net revenue, or at least most of it. The losses never showed up, and so the question is why? Obviously, economic fundamentals were worse, and that is that, of course, we've been able to liquefy the banks to the point where they've been able to kick the can down the road. So they're sitting with underwater real estate loans, both on the resi and the commercial side.
This sounds like a precarious situation. Why haven't the banks at least been forced to start to clear the system? What's happening?
The policy of the regulatory establishment is effectively regulatory forbearance. They can't afford to lose the banking sector again. We almost lost it the last time.
Right, but isn't it a situation the longer you wait, the more of a problem it's going to become?
Well, the argument, the countervailing argument, if I can take the bank side for a second, is, look, I've got a certain amount of capital. I expose that capital to risk in the marketplace. It is supposed to absorb intermediate effects of economic fluctuations. And to the extent that I eventually have losses at the end of the day, over time, I will recognize those losses. That's the way leveraged banking is supposed to work. The problem, of course, is that when you start looking at the nature of the residential real estate market, you're down, what, 30% from the peak? You're going to end up down, I don't know, 35, maybe 36, 37. At that point, you have an enormous percentage. I mean, even today, of the 52 mortgages that are out, 52 million mortgages that are outstanding in the United States, you know, nearly 30% of them are underwater, and that will just become worse over time. So effectively, the policy of both the regulators and the banks is a straddle, right? They're trying to get from point A to point B, understanding that in between things are going like this. But if by the time we get to point B and the loans mature, or people need to sell their homes for whatever reason, people will die, need to move, whatever the reason is that they have to sell their homes, or they actually see their loans mature, by that point, hopefully, the banks won't experience the types of losses that today, if they mark the loans to market, would be embedded in them.
Well, how do you clear the system, so to speak? I mean, 20 years ago, we had the RTC. Nowadays, it seems to be there's a real question out there. How do you move the rat through the python, so to speak?
That's a very good point. Of course, the RTC really was just commercial property. And one of the things about commercial property that is very different from residential property is it doesn't really matter to the economy who owns it. If you own an office building or I own the same office building, it doesn't matter to the economy. But houses actually people live in, and so consequently it creates societal and economic effects that are very disadvantageous if in fact you start throwing people out of their homes. So the RTC is somewhat comparable, or the S&L crisis is somewhat comparable, but the magnitude of what we're experiencing right now is just, by leaps and bounds so much bigger. And it makes it very, very difficult for the regulators simply to say, well, let's just liquidate the collateral, which is what effectively the RTC did.
We're about 2 months into the new year, 2011. There haven't, at least publicly, there haven't been a whole lot of changes into the ways that banks do business. What do you expect to happen there?
Well, obviously, we're going to see progressively more and more regulations come out of the various bodies, and we saw a couple come out last week. We'll see a few more over time. I think that a lot of the regulatory risk is baked in, meaning people. Let's face it, the banks are not exactly trading in multiples of book today, right? I mean, they're especially the two most or the one most troubled bank, which is Bank of America, is extremely hit. But we have concerns that go beyond Bank of America. I mean, we have concerns about even Wells because of its enormous, just the enormity of its real estate loan portfolio. So, but going back to your question, the regulatory environment is going to again be forced to deal with how to accomplish the straddle that we just talked about. If you force people too quickly into raising additional capital, or force them into divesting themselves of profitable business lines, you're just going to make the job harder to get from point A to point B. And so there are two possibilities here, and this is really where the rubber meets the road. Either we're going to tolerate a Japanese type of situation where effectively our banks are not performing their mission of capital formation for a very protracted period of time, or being Americans and not having the patience perhaps of the Japanese culture, we're going to want to accelerate that process and actually get back into business again. There have been a lot of good numbers on a relative basis, relative to some very bad times the last 2 years. The economy looks like it is accelerating a little bit, but when you actually parse through those numbers, you start to learn some very, very disturbing things. For example, obviously housing still is an enormous headwind. If you project forward and assume this week the mortgage MBA numbers came out, and the huge drop in applications for both sales and refinancings. And if you go down one step further and look at, say, retail sales, all you're seeing really in retail sales is a succession of microcycles where consumers are paying down their credit cards and then reborrowing against them in order to spend. And every time they get back to their credit limits, since credit limits are not expanding, since personal incomes really are not growing very much on a real basis, and certainly relative to the headwinds in commodity inflation where you're talking about gasoline prices and food prices going up, real net disposable income is being adversely impacted. And so since you don't have more income and you don't have more credit, where's the growth in retail sales to come other than intermittently, with growth rates that are going up and down over time?
Interesting. Wanted to get your thoughts on the foreclosure issue. How big a problem is this going to be for the banks? We had a major opinion come out earlier this week from bankruptcy judge Robert Grossman, Eastern District of New York, effectively saying that the electronic tracking system that banks use for mortgages and notes doesn't confer standing in a foreclosure proceeding. This seems like a problem for banks. How big a problem is it going to be?
Well, the MERS issue, it's called MERS, the system. The MERS issue is a very interesting thing for the legal community. They're going to have to deal with the fact that we've effectively separated mortgages from the actual notes. To the extent to which we actually have a Superior Court ruling or potentially Supreme Court ruling that in fact that violates essentially what is common law. I mean, it goes back to the creation of the indenture.
Right. This is
the
kind of foundational.
Yeah, it's very foundational law. Then obviously you have an enormous problem. I personally don't believe that's going to happen, and I don't think the MERS issue is going to be the biggest problem. More to the fundamental issues, you obviously have extensive documentation problems, and many courts have basically said to lawyers, look, do not come in here attesting to the quality of your documents unless you want to be sanctioned if you're lying to me. And judges have taken very, very tight rulings in their courts. And I believe that's going to continue. That has really slowed down the process in a measurable way.
Sure. It's something like 5 years now to foreclose on a home in New Jersey.
Right.
It's an enormous amount of time.
On top of that, you've got the challenges from state attorneys general. You've got federal oversight that is greatly toughened. You are really slowing down the process. And here's the punchline to this discussion. The banks are thrilled. They're not telling you. But the truth is that we have, you use the notion of a bubble going through the python or whatever it is you said. And the truth is that we've had this enormous quantity of foreclosures. We have 6.5 million homes in shadow inventory right now that are either visible or, visible plus shadow inventory, that are moving through this snake, and a lot of those homes that have been in the foreclosure pipeline for literally 18 months, 2 years, are nearing the end. There's not much you can do other than repossess them and try to sell them. Nobody wants to have this REO. Right? And obviously the housing market isn't good enough to be able to recover meaningful portions. If you look at what's going on in the RMBS sector alone, their average recovery on foreclosed loans is 36%. Right? The banks, who have a much larger portfolio, there's only 1.3 trillion of RMBS loans, private label, outstanding. But there's 2.9 trillion of whole loans, including the HELOCs, in the banking system. The banks don't want that REO back, and they don't want to be taking those enormous losses. So consequently, I was being a little bit facetious before when I said the banks are celebrating, but the truth is that kicking the can is in fact our policy today.
It sounds like there might be a little bit of grief coming when looking at the banks. What's the timing? What are you looking for?
It's difficult to put precise dates on it, but I do believe that there are a number of catalysts that could force people's hands. Obviously, the biggest one is, do we go into the spring so-called selling season in the housing market and find that, in fact, there's not a whole heck of a lot of traction? There's a couple of things that are likely to create that situation. One is that we've seen an uptick in mortgage rates. That has been directly responsible for what's gone on in a slowdown in refinancings and certainly purchases. So you do have a double whammy, really, in the housing area when you start to see both softening prices and rising rates. One is the consumer, the potential home buyer, says, I'm not going to buy now, I'm going to wait until the price goes down, right? And then, of course, it becomes more expensive for him to buy on top of that because of rising mortgage rates. So, there's one guy, Mark Zandi, who's a guy that I'm sure you and I both respect, came out with a very important point in a report recently, and I think pretty much everybody in the analytical side of this business understands this. While pricing and affordability have dramatically changed, housing is theoretically more affordable than it's ever been, right? And pricing certainly has come down 30%. It's likely to fall further. The fact of the matter is that we still have not hit the tipping point where you can go out and buy a home and rent it out and make money on that deal.
Right.
In some markets you can. Phoenix you can, for example. But in the New York market, in most large markets in the country, you still haven't hit that price to rent ratio that puts you back into the status quo ante. And the status quo ante is about 1997 to 2000, somewhere in there, where it was profitable, if you wanted to be an investor, to own a house and rent it out. You got a decent return on your money. Even at today's ridiculously low interest rates, it's still not profitable to do that from the standpoint of making a decent return on your equity. And so in a lot of markets. And so consequently, until that works itself out, we really haven't hit the bottom.
Well, we'll certainly be watching it. Dan, I want to thank you so much for your time today. This was really interesting. That's Dan Alpert. He is the managing partner at Westwood Capital, based here in New York. If you'd like to learn more about the issues we just discussed, go check out our offerings on BloombergLaw.com and on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.